Baby, you gotta watch this because it's gonna absolutely blow your freaking mind.
Just yesterday, I was looking at an article about the valuation of tech versus the market, and we are above what we were in 2000. The tech bubble is
Heaven forbid, folks, tech against the market is more overvalued than it was during the dot-com bubble. That must mean things are about to burst. Though I'm kind of, a little hesitant on believing so, but let's take a look, because when I was looking for articles and comparable to what he's talking about, I wish he'd reference it because I can't find those articles. In fact, most of the articles I'm finding are pretty much the same thing you're talking about, but from 2 to even upwards of 5 damn years ago. I mean, take a look at this article, for example, saying the S&P 500 Information and Technology Index, which includes the iPhone maker, Apple, chip maker, Intel, currently trades for 7.5 times its company's reported sales. That's more than double. That's 2.9 times the average valuation over the past 30 years. But to be fair, the valuations don't look quite as stretched when you compare them to profit rather than revenue. And that's what I kind of want to talk about, because if we just look at the S&P 500's price to earnings multiple, yes, it is rather expensive compared to historical averages of around 15 to 16, but it is nowhere, and considering I think there's probably more tech companies sitting in the S&P 500 by weighting than there probably was during 2000, the price to earnings multiple isn't anywhere near the dot-com bubble levels. So am I really that worried about tech companies bringing down the entire market? Probably not, but are they expensive? Well, let's talk about it. Nvidia trading at 100 times earnings. That means if the company never grew earnings and it just stayed where it was today, it would take you over 100 years to get a full rate of return. I'm saying that is, but realistically, this company tanked and then exploded. What caused that? Earnings, revenue. Look at this. Revenue jumped up 100%. If they could grow revenue at 100% clip and continue to do so into the future, would I have a problem paying 100 times multiple? Hell no, I wouldn't. All of a sudden, these high valuations make sense. And again, when the market is starting to see declining revenue like it did in the initial start of the interest rate cycle, the stock started to over project that into the future as people presumed, hey, Nvidia is overvalued. It's not growing anymore. Let's sell the stock up. Let's make the valuation more sensible. And the stock crashed. In order for the stock market to crash, revenue, earnings, you need to hinder those aspects of the market in order to see any substantial crash. Could you see a valuation correction? Sure. But you're not going to tank the market unless revenues crash. Look at Adobe trading at a 53 times multiple right now. Is that expensive? Yeah, it's only growing revenue at a 10% clip. Do I want to buy Adobe here? Might have great prospect into the future. I'd have to look into those prospects and see if it's just, but it is an expensive company here. I'm not going to argue that, but people have literally been saying this for the last 5 to 10 years, and there is no way we're stepping back 5 years in time in market valuation unless something catastrophic happens to the fundamental base of our economic reality as it sits today. It's just not going to happen, folks. So people 5 years ago missed out on one of the greatest rallies in human history. Anyone that's been complaining since 2008, you're a moron. You've missed out on insanity. They printed so much damn money. It's inflated assets to a level where we can never return back to where we were. I'm sorry, it's just not going to happen, and the economy persists to be strong. Look at the Qs. The Qs are a good representation of the NASDAQ, which is very tech heavy, which is trading at a almost 33 times multiple today, whereas the 3-year average is around 30 and the 5-year average is around 28. So we are a little bit expensive today, but over the last 5 years, the market has persisted to trade at these wickedly high multiples with some of these tech companies because they're growing at absurd paces. So I don't need some clown on the internet trying to instill fear into me and remind me of, oh my God, things could be horrible tomorrow, but they're not really today, and it doesn't make a whole lot of sense based off the inverted yield curve and all this backdated data that never really, if you were so genius with all of this, then why don't you become a billionaire in the next week? I mean, if you're that smart about feeding me all this fear, it's fugazi. It's just fear porn. It doesn't lead to anything. It's nonsensical data is all as it is, folks. And I've been iterating this to you as I've been buying stocks relentlessly because there is good valuations in the market, you idiots. Yeah, we can all focus on tech because it's all anyone wants to talk about, but the bottom half of the market, when you're talking about like financial stocks, utilities, and REITs, I mean, they have tanked, they have crashed, they have gone through the recessionary environment. They don't have the same liquidity or mortgages or debt control that mega cap tech companies do. That. I mean, Google and these companies can pay off all their debt tomorrow pretty much if they wanted to. You think these big utility companies can? No. So that's the market we're in. There is a market crash happening where the market deserved to crash. So, I mean, that's what we're seeing going on. So if you don't think the market's crashed, you're an idiot, first and foremost, and you're not taking advantage of what exists today. And I'm trying to do it as cautiously as possible because obviously I've taken a stance back and I've done a very conservative look into my portfolio over the last 2 years. I mean, since 2022, going into that initial drop, I sold my individual stocks, which if I held my tech companies, I'd be doing great today, but I didn't know what was going to happen tomorrow. And I conservatively put it into ETFs. Now, I'm still thinking there's more value in things like SCHD and VDY because that's where the market's been hit the hardest with a lot of these awesome companies. But yeah, I'm continuing to buy them. I'm going to keep buying VDY. And in fact, I'm looking to even buy tech. As soon as the market year turns over and I can start re-adding to my TFSA, which again, I liquidated to buy a piece of real estate, I'm looking at cost averaging into the Qs. I'm looking at buying tech companies like Tesla because I believe in 20 years, the value tech is going to have on society is going to be just as substantial as it has been over the last 10 years. And it's hard to put a valuation on that, but I do want to be a part of it because I think it's going to be huge. I think there's going to be massive market cap expansion periods still into the future. Even though we could see a correction maybe over the next 5 years, who the hell really knows, right? That's why I keep telling you, keep buying them. And take a look at the markets today. Energy is about to get wrecked. I'm sorry. If you are a believer in energy companies, if you are a dividend-focused investor, it's likely you have exposure to energy stocks, and they're very cyclical in nature, which is why I limit my exposure as much as possible to the energy sector. If I was older in retirement, I wouldn't worry as much, but oil is crashing. It's a very cyclical cycle that you just can't avoid, and we're going back into a cooling period, which is eventually going to hinder earnings and continue to hit some of the energy stocks, which Canada is heavily focused on, so you could see some further pain in the broader Canadian markets, but like I said, I think it's just more or less a buying opportunity. But nonetheless, take a look at the S&P 500 here, where there's a lot of despair going on depending on what you're looking at. Firstly, tech isn't where the despair is. It's blowing up. I mean, Microsoft, Apple up 5% this week. Google, probably the best value tech company out there. It's doing pretty well this week. And recently, even Berkshire Hathaway has been under the gun. Warren Buffett causing drama? What? No way. Yeah, the guy apparently has been buying stock. Somebody illegally disclosed some information to the press saying that, hey, on his tax returns, he has been buying stocks that Berkshire owns. And apparently Warren Buffett was quoted saying it's kind of against company policy for me to be buying companies that Berkshire owns. So if Berkshire is buying Bank of America, I'll buy JP Morgan. Turns out he wasn't doing that. So I don't know how big that drama is or what the big deal is with it, but I'm sure we'll hear more as time goes on. Tesla getting a little bit more wrecked today. Again, oil stocks kind of going through a bit of a calamity, which they'll continue to. There's a lot of mixed bag going on, and it's going to continue to go on. And a lot of this through the week and this volatility has been caused by the Fed saying that they're not confident that it has done enough to bring inflation down. And this is them trying to cool the markets. They've done enough. Let's be real. They don't need to raise interest rates anymore. They could sit at this higher rated market, and inflation is going to come back down to a nominal rate, likely in the next quarter or two at most. And then we can go back to an interest rate cut cycle where we'll come back down to a nominal 3 or 4% rate. And that's going to take the bottom half of the market up. So even if tech stocks are overvalued, the bottom half of the market will likely start to recover because earnings were going to pick up. And as mentioned, earnings seem to be the end-all be-all to where these stock prices seem to be going these days. And, if these companies that are getting absolutely devastated, that are trading down 30 to 50% because of the higher interest rate environment, start adding that back to their bottom line, guess what? These stocks are going to go up. It's almost like clockwork. It's so damn predictable. But taking a look at Canadian earnings, I want to do some individual videos, or I would have talked about them in this video, like CapREIT, some of the Canadian real estate trusts. I mean, we're taking a look at Constellation Softwares here, which came in at a surprise, and their stock continues to crush, one of the best performing Canadian stocks of all time. I mean, in the last 5 years alone, this company's up at damn near 228%. This train just doesn't seem to want to stop. Is it expensive? It is insanely expensive, in my opinion, but that doesn't seem to slow the train down. It's always been expensive. This is kind of a diversified, kind of software business. They just kind of acquire all these different like software based businesses. So they've got a really intriguing portfolio, and they're slowly becoming one of the largest companies in Canada, very consistently for that matter. But taking a look at some of your comments, Vic saying, early, but my New Year resolution is to just buy the S&P 500 ETF. In all honesty, my 3-year stock picking has not done so well. And I do got to applaud you on this very intelligent realization, the self-reflection that too many people don't go through. And that is, I made a deal with myself that over a 5-year period, if I underperform the market, that I would realize I don't know what I'm doing and I'm just going to start buying ETFs. Luckily, I've done very well over the last, several 8 years. But in 2022, I recognized I didn't know what was going on anymore. I sold all my individual stocks and I went really heavy into ETFs. And that's what I'm kind of been persisting over the last year and a half. And I'm going to continue to do that because I'm just not comfortable anymore with the direction the market's going. However, I don't think there's anything wrong with speculating with a small percentage of your portfolio. So make sure you're doing the right thing by putting the right amount of money into index funds to get you to your goal by retirement, and then take any extra money you have that builds up to 5 or 10% of your portfolio and speculate. There's nothing wrong with speculating in the market. It's human nature, and I'm going to be doing it with companies, which like I said, I like Tesla. I like some companies out there that I do want to buy. Too many clowns basically spreading fear. If you're not buying in a few months, you'll find another excuse to not buy at all, and I 100% agree. Always be buying. It doesn't matter what it is. There's value out there somewhere. And you got to find it in your own heart to what that value is. If it's cost averaging into index funds, picking up some of these stocks that have crashed already that pay huge yields, if that's where you think the value is in the market, but you got to be buying. You'll never get to retirement by just getting a wage. It's unfortunate. It's a reality we all face. You can't sit on the sidelines, and you're not going to make it off bonds and GICs. I'm sorry. You're never going to own enough bonds or GICs at a 5% return to get to retirement because they're going to cut rates. It's going to be a short-term ride. The reason for the markets to crash are there. There are about 100 of them, all flashing red, and they are super clear. Sometimes I wonder if the market can crash while most of the markets knows that the signs are there. And again, I don't think the signs are as clear as people like to think they are. Yeah, inverted yield curve. Yeah, there's tons of data supporting that the markets could go into some crash. But there has to be something that pricks a bubble, like there was in 2008, like there was in the dot-com bubble. Like there has to be something that pricks the valuations. And you can't prick valuations when revenue and earnings are growing. I'm sorry, it's just not going to happen. And it's only going to get better when interest rates start coming down. So unless a black swan event happens or one of these geopolitical events kind of bleeds into the Western world, it becomes insane to like nuclear level. Again, that could crash the market, but then you can't say you're right because that means none of the past indicators that you used to predict that we're going to head toward a crash was a defining factor to the crash. So it's all fugazi. It's all fugazi, folks. But I'll pass the question off to you. I'd love to know what you think in that comment section below.